welcome to The Global View, the show where we look at ways for investors to make money beyond the ASX-listed universe. I'm your host, Juliette Sarli. Well, on Friday, US markets fell as the non-farm payrolls report showed a continued slowdown in the labour market. The S&P 500 and the Dow had their biggest weekly drop since March 2023, and the Nasdaq registered its biggest weekly drop since January 2022. Mega-cap growth stocks led the losses, with Tesla down more than 8.5% and Broadcom was down more than 10% after the chipmaker forecast fourth quarter revenue slightly below estimates, hurt by sluggish spending in its broadband segment. The Philadelphia Semiconductor Index was down 4.5%, its biggest weekly drop since March 2020. Supermicro Computer dropped almost 7% as JP Morgan analysts downgraded the AI server maker shares to neutral from overweight. Well, the non-farm payrolls data showed employment increase less than expected in August, with 142,000 jobs created in the month. The unemployment rate falling to 4.2% though, from 4.3%. Now that suggests the labour market is not falling off the cliff to warrant a half-point interest rate cut from the Fed this month. Average hourly earnings rose 0.4% after gaining 0.2% in July. Wages increased 3.8% year on year after advancing 3.6% in July. Traders' bets for a 25 basis point rate cut in September stand at 73%. The benchmark 10-year Treasury yield fell to a 15-month low, falling as much as 3.65%, the lowest since June 2023. Interest rate-sensitive 2-year yields were down more than 10 basis points, their lowest since March 2023. Currencies mixed against the US dollar, but we are seeing a little bit of a comeback now. The Aussie tracking at 66.7 US cents, and $1 is buying 142.3 Japanese yen. Let's get now to Isaac Poole from Ascalon Capital joining us for his take on what we can expect this week. Good to see you, Isaac. I mean, the way the market reacted to that jobs report, it was similar to that sell-off in August and almost as if we are going to be seeing some kind of a recession.
That's right. I think the numbers increase the risk that we see a recession, but it's certainly not locked in. I think what you really saw there was some growing concerns that perhaps the US labour market isn't as resilient as everyone had priced in or hoped for. And it wasn't just the most recent reading, it was the revisions lower to recent months, which really highlighted that the number of jobs that have been added over the last 5 or 6 months are a lot lower than we had than we'd thought right up until that Friday number. And that really, I think, drove some of that negative sentiment.
So potentially we may not see the soft landing. What does the Fed need to do this month, Isaac?
Well, they need to get going. They definitely need to start cutting. But the challenge is that it's still not really clear that the data give them a really strong reason for cutting 50 basis points. And if they did go ahead and cut 0.5%, it could signal something to the rest of the market that perhaps the outlook is worse than even the Fed had feared. Yeah, and that's the risk that a panic 0.5% cut could worsen sentiment. So I think the Fed will go steady as she goes and deliver a 0.25% rate cut, and probably start cutting at most of the meetings going forward. And that's going to be the minimum that they need to do, I think.
So this week we look at the inflation data, but you say not as pivotal as the non-farm payroll. So that's now in the rearview mirror. But I guess we are just having this wait and see to see what the Fed does.
Yeah, that's right. Inflation is very clearly trending lower. It's not falling off a cliff, which the Fed will be happy about. It doesn't look as if it's going to re-accelerate. And so it becomes less important than the labour market number. That said, if we were to see a bit of an upside surprise, that could push back again on market hopes and growing expectations that the Fed could cut 0.5%. And I think that could be a cause for volatility this week. So still an important number, but perhaps less meaningful than the totality of the labour market numbers.
So you're not expecting that we'll see this emergency rate cut in September, but you've got the Fed funds at or below 3% next year. So how do we get there?
I think that it's going to be no emergency cut yet, but growing need for emergency cuts over the next 12 months. And when you look at the US economy, there's three really good signals or bits of information that you can take to point towards the economic outlook. One is the manufacturing PMI, which has been weak and suggesting below trend growth for several months now. The other is the labour market, which is clearly slowing, and the unemployment rate is at levels that historically had been consistent with recession, and then the yield curve, which I think has just crept back into normal territory, that is positive from inversion where it's been for more than a year now. And historically, when that yield curve reinverts or normalizes, it's been consistent with recession. So there is a growing risk there, and I think the Fed is going to have to get towards half percentage point rate cuts next year, and we could certainly see the Fed funds rate at 3% or below, and the rest of the curve could rally lower as well.
All right, well, let's talk about what this all means for markets. We talked about how all the three key indices in the US had their worst week either since 2022 or early 2023. When we look at the fact that the economy could be slowing, does that mean stay away from the equity market now?
I think it means proceed with an abundance of caution at the very least. What you look at when you look at equities is valuations, and they're stretched. They're still very elevated, even with the volatility we've seen recently. And we've been characterizing this as PEs or multiples that are pricing in a re-acceleration of growth. You really need to see earnings growth pick up to justify those multiples over the next 12 months, and it just isn't moving in that direction. So even if we don't get a recession and that risk is increasing, even if we just see growth slow further from here, it's going to be really difficult for earnings growth to justify the level of valuations we see. So that means we may need to see some multiple compression that could happen through prices moving lower. And that just suggests being really cautious around the equity market right now.
So potentially a little bit underweight equities. Does that mean you go overweight treasuries?
That's still the place to play, I think. We've thought that US Treasuries looked attractive for some time, especially back when yields were up around 5%. They've now come in quite a long way in a very short period of time. But that said, if the economy does continue to slow, if the Fed is forced into emergency rate cuts over the course of next year, it leaves duration out beyond the sort of 3, 4, and 5 year parts of the curve looking pretty attractive still. So we do think that there's an opportunity there to add in some US Treasuries, get what is still a relatively okay yield, but more importantly, build some downside protection and resilience into your portfolios.
All right, let's move to the China picture because we get inflation data from China today and a little bit more data throughout the week as well. It's interesting you're saying you're not expecting that authorities will do what they've done in the past and throw the kitchen sink at the economy.
Yeah, I think they're going to be pretty cautious around delivering sort of full-scale monetary or fiscal support at this point. I mean, they can look at the rest of the world just as anyone else can and see that the US economy is slowing. And so they don't necessarily want to lean against that right now. I mean, China's economy is weaker than they would like. It's very clear that the housing sector continues to drag on economic growth. And they have delivered a lot of cumulative monetary and fiscal policy support to offset that. It's having some impact, but it's not going to deliver a strong re-acceleration of growth. And I think China's authorities will just hold off delivering a lot more until they get a clearer idea of what's going to happen to the rest of the world. They don't want to waste their ability to support their own domestic economy just yet.
All right, Isaac, always a pleasure to chat. Have a good day. Isaac Poole there from Ascalon Capital. Let's just get a check on where the local market is set to open when it opens in around 5 minutes. No surprise, we're expecting to take that negative lead from global markets, and a drop of 1.3% or more than 100 points is suggested. There's been a new boss, though, at Westpac. Anthony Miller been appointed the lender's group CEO and managing director commencing mid-December. Miller is currently chief executive of Westpac's business and wealth division. Now, he'll succeed Peter King, who's retiring after a 30-year career at Westpac, including 5 as CEO. Westpac Chair Stephen Gregg saying Mr. Miller is the right person to take the company into a new era, saying he has deep expertise in financial services and global banking and has built a considerable track record of delivery over 25 years. Well, today the monthly business turnover indicator is released. Paladin Energy hosts an investor meeting. CSL, Hub24, Super Retail Group and Viva Energy trade ex-dividend. As we mentioned with Isaac, China inflation data due. And in Japan, we get the second quarter GDP print. That does it for this edition of The Global View. Stick around, Nadine is coming up with the Open next.